want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is one of the world's only major providers of industrial gases. We all like stuff, right? For example, you probably like the device you're using to watch this very video on. Well, the various products we all use and enjoy every single day must be manufactured, and the manufacturing processes almost always require industrial gases. That's where this company comes in. Not only that, but it's part of a global oligopoly. That's why its revenue, profit, and dividend should all continue growing at high rates for years to come. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explained exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Air Products and Chemicals Inc., which appear to be trading at a significant discount today. Air Products and Chemicals Inc., stock ticker APD, is a major global producer and supplier of industrial gases, now the largest supplier of hydrogen and helium in the world. Founded in 1940, Air Products and Chemicals is now a $58 billion by market cap industrial gases major that employs more than 20,000 people. The company's fiscal year 2023 sales were reported through 4 industrial gases business segments organized by geography. Americas 43%, Asia 26%, Europe 24%, and the Middle East and India 1%. Corporate and other accounted for the remainder. This is a wonderful and extremely powerful business model. I'll give you 3 reasons why. First, industrial gases are critical input for the manufacturing processes of many different end products ranging from electronics to vehicles. Second, because of the critical nature of these industrial gases and because constant and reliable access to these gases is a must, a manufacturer will set up a long-term contract with a dependable provider of said gases. Complex infrastructure is then installed at a manufacturing site to ensure reliability, which makes it costly and difficult to switch providers later. Third, Air Products and Chemicals is part of a global oligopoly. Only 3 major companies in this space control the vast majority of the global market share. Let's review. Air Products and Chemicals combines necessary input with long-term contracts fortified by complex infrastructure, and they do all of that within the favorable confines of a global oligopoly. That adds up to a company that practically prints money and basically cannot lose over the long run. And it's why Air Products and Chemicals is positioned so well to continue growing its revenue, profit, and dividend for years to come. To date, the company has increased its dividend for 41 consecutive years. That easily qualifies this company for its prestigious status as a dividend aristocrat. The 10-year dividend growth rate is 9.8%. In and of itself, that's strong, but what's even better about the dividend growth is how consistent it's been. Air Products and Chemicals has been consistently increasing its dividend at a high single-digit rate like clockwork, and you get to pair that kind of dividend growth with the stock's yield of 2.7%. It's awfully hard to be unhappy with a near 3% yield and a near 10% dividend growth rate. Assuming a static valuation, the sum of growth and yield should roughly equal out to an annualized total return. That yield, by the way, is 60 basis points higher than its own 5-year average. Based on fiscal year 2024 adjusted EPS guidance at the midpoint, the payout ratio is 54.1%. That payout ratio strikes a great balance, nearly perfect really, between retaining earnings for growth against returning cash back to shareholders. This dividend aristocrat brings the goods. You get yield, growth, and safety all in one package. Excellent dividend metrics right across the board. Looking at business growth, Air Products and Chemicals advanced its revenue from $10.4 billion in fiscal year 2014 to $12.6 billion in fiscal year 2023. That's a compound annual growth rate of 2.2%. At first glance, this is quite mediocre. However, we have to look beneath the surface here. Management decided to intentionally make the business smaller and more efficient through what was called the 5-point plan, which was introduced in 2014. This plan was designed to focus the business on industrial gases by jettisoning non-core operations. Executing this plan led to spinning off the Electronics Material Division in 2016, and the Performance Materials Division was then later sold in 2017 for $3.8 billion in cash. This plan has worked out nicely. Earnings per share grew from $4.61 to $10.33 over this time frame, which is a compound annual growth rate of 9.4%. See, that's more like it. Management wanted a higher margin business, and they got it. We can now see how well bottom line growth matches up with dividend growth over the last decade, almost the same exact number. Really good stuff here. Looking forward, CFRA believes that Air Products and Chemicals will compound its earnings per share at an annual rate of 12% over the next 3 years. So it's basically a continuation of the growth acceleration that started to play out between 2016 and 2017. I think this passage by CFRA sums it up well. And I quote, "We think Air Products and Chemicals has a solid backlog of growth projects with a focus on expanding the scope of syngas supply agreements, acquiring air separation units, and winning agreements in large industrial gas projects. Air Products and Chemicals is well positioned to capitalize on gasification related to carbon capture and hydrogen mobility, which are long-term secular tailwinds," unquote. Simply put, Air Products and Chemicals is tapping into multiple areas where secular tailwinds are present. It's a great business located in a great spot. This kind of long-term setup doesn't get much better. Supporting CFRA's number is fiscal year 2024 guidance from Air Products and Chemicals, which is calling for 13% year-over-year growth in adjusted earnings per share at the midpoint. This kind of low double-digit earnings per share compound annual growth rate would support high single-digit dividend growth with no issues whatsoever. In the end, it looks like status quo to me. That is to say, Air Products and Chemicals should be able to keep growing its dividend at a rate that's similar to what's already transpired over the last decade. Seeing as how the stock yields almost 3% to start with, that's a compelling arrangement. Moving over to the balance sheet, Air Products and Chemicals has a rock-solid financial position. The long-term debt-to-equity ratio is 0.5, while the interest coverage ratio is over 17. The company's approximate $7 billion long-term debt load is fairly benign for a company with a market cap of nearly $60 billion. Moreover, cash on hand offsets nearly half of the debt load. Great balance sheet. Profitability is also great. Return on equity has averaged 16.3% over the last 5 years, while net margin has averaged 19.5%. Air Products and Chemicals is routinely producing high returns on capital, which I love to see. It's a world-class enterprise in my view. And the company does benefit from durable competitive advantages, including global economies of scale, large barriers to entry, high switching costs, a global oligopoly, and long-term contracts with fixed infrastructure. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. A recession would impact the business in some way, as demand for industrial gases is correlated with manufacturing activity. Since the company is heavily involved in a variety of major energy projects around the world, ongoing changes in the global energy complex adds uncertainty and risks. Input costs can be volatile. More than half the company's sales come from outside of the Americas, heavily exposing the company to currency exchange rates and geopolitics. Joint ventures are employed in order to help fund growth projects, but the financial health/commitment of partners may vary over time. I see these risks as quite acceptable relative to the quality and growth profile of the business, and the valuation relative to the quality and growth also appears to be more than acceptable. The stock is trading hands for a PE ratio of 25.4. That compares favorably to its own 5-year average of 29. Furthermore, using fiscal year 2024 midpoint adjusted EPS guidance, the forward price earnings ratio drops to 20.2. The sales multiple of 4.6 is well off of its own 5-year average of 5.6, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. Now, this 8% number is as high as I'll allow for, but if there's any company that deserves the benefit of the doubt, it's this one. Air Products and Chemicals has been reliably increasing its dividend for decades. The company's demonstrated earnings per share and dividend growth over the last decade both exceed 8%. And the near-term forecast for EPS growth, which would support light dividend
dividend growth is well over 8%. In addition, the payout ratio is moderate. Overall, I just don't see why this company can't grow its dividend at a high single-digit rate over the coming years. The dividend discount model analysis gives me a fair value of $378. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates APD as a 4-star stock with a fair value estimate of $314. Safari rates APD as a 5-star strong buy with a 12-month target price of $336. I came out on the high end this time around. Averaging the three numbers out gives us a final valuation of $342.67, which would indicate the stock is possibly 24% undervalued. Here's the bottom line, guys. Air Products and Chemicals Inc. is a world-class enterprise that benefits from being part of a global oligopoly. It produces high returns on capital, and there are numerous competitive advantages in place. With a market-beating yield, high single-digit dividend growth, a moderate payout ratio, more than 40 consecutive years of dividend increases, and the potential that shares are 24% undervalued, long-term dividend growth investors looking for a wonderful business at a wonderful price should take a good look at this Dividend Aristocrat. And now for a special news announcement. Northrop Grumman Corp., stock ticker NOC, recently approved an additional $2.5 billion for the repurchase authorization of its common stock. This move increased the outstanding authorized amount to $3.8 billion, which is more than 5% of the entire company's market cap. This stock is down about 11% this year, pushing the earnings multiple to below 16. The company sees value in its shares, and so do I. Take a look.
Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.